Okay, and welcome everyone to my very first multiple venue live stream. We should be streaming live on X, on YouTube, and on Facebook all at the same time. And I wanted to come on because for obvious reasons, right? I mean, Bitcoin goes from 63 to 49, 48. Prices of many of our stocks 15, 20% down. But truthfully, the action is not really being driven by our investments. It's really what has been going on for the last 6 months, 6 to 8 months in particular. I mean, it's the big mega cap stocks that are really seeing now big selling, and then there's a number of strategies that people have put on over the last 6 months that have sort of like created the environment for this to happen. But before I go into all that, I want to put in all the usual things I do when I do my YouTube video, which is a legal disclaimer that this live stream and the content from ATG Digital Media, which by the way is our company, is not investment or financial advice, is presented to you as opinion, information, engagement, and entertainment. Uh, any of and all of the content from AT Digital can contain errors, oversights, and mistakes, and understand that investment operations have significant risks that can lead to the loss of your principal. I, the owners, employees, contractors, own, trade, transact, and securities that are mentioned in this live stream and all the content from ATG Digital. We do not take money from companies or from crypto promoters to recommend their stocks and crypto tokens. And this is a very quick recap of all the free content we put out. The Substack is something I would recommend you read today. I talk about sort of like this panic within the context of other panics. And I'll probably focus on that on my YouTube video tomorrow as well, which I'll live stream at somewhere between 12 and 1. And this is all of my socials. All right, so what is going on? Like, why is this happening like right now? Like, what changed between like Wednesday of last week and we saw the first signs of a panic on Thursday, and we saw some actual panic with Intel, negative 28%. And then obviously this morning it's bedlam, right? It's complete bedlam. Everybody's like, I want out, right? The same folks that were all in now want all out. I mean, so what are you seeing? Like if you're looking at price charts, and I'm going to just put up, this is how I track markets on a day-to-day basis. I use this website called Stock Charts. I've been using it a long time. It's not the best, it's not the greatest, but it's what I know. And so it's kind of like easy for me to visualize and understand like what's going on. Like, let's look at arguably the most popular stock in markets over the last 6-8 months, Nvidia, right? I mean, so Nvidia, what is that about 100? But look at the price. Let's say look at the price action today, right? Okay, so what are we looking at here? Oh, this is an update. I need to change this. So what are we looking at here? I'm just gonna lift this up a little bit. We don't need to see all of it, but you can see it's Nvidia chart. And I'm going to make a couple of points here that people probably won't like if you own Nvidia, which is that one of the things that you can actually see here, and I'll contrast this with some of the other charts that you're seeing. If you look at Nvidia, one of the things you'll see that even today, there is no gap down. Now, what is a gap down? Well, let me show you what a gap down would look like. For example, this is one, let's say in our universe that I focus on, innovation and growth. Here's MicroStrategy. You see that has a gap down, right? And what's a gap down? In other words, you go from one price, and then there's air, and then there's the next price. And gaps down are driven by people who are leveraged, and they get a call from their broker and says, hey, not enough money in your account. Please add money or we will sell your stock. We will sell your stock. You have until 11 a.m. And if you do not, either tell us that money's on the way, and it needs to be firm money. It can't, like, I have had margin calls in my life, and I was like, well, I sold something. They're like, no, you need the money now. You need to either show us that you're wiring the money in, or or you need to sell stock. So you can't like sell stock today to meet the margin call. You have to have the money today. If you have a really good relationship with your broker, maybe they'll give you like a credit line, or if you like sell so much. But a gap down is driven by like a forced selling, And contrast that to Nvidia, where you don't have this gap down. And that says that this is a different scenario. Okay, now I'm sharing the Nvidia. This is a different scenario than MicroStrategy. This is a scenario where people just really own way too much Nvidia. And as they are natural sellers, sure, there's margin calls embedded in there, but there's also enough actual selling by actual folks that are long Nvidia, liked it for its fundamentals and all of these things, and they are selling. And that's why there's no like immediate gap down. There's actually like at every price along the way, there is someone that is actually buying and selling. And the reason I bring that up is that, well, sure, MicroStrategy has had a good run, but it does not compare to Nvidia. I mean, Nvidia is still after, even after it's come off from 150-ish down to 100, is still a $2.5 trillion company, So the impact and the market capitalization loss on Nvidia is enormous. I mean, it's quite big. It's just, even for like, it's relative to the size of the U.S. stock market, it's enormous. The amount of market capitalization loss for MicroStrategy, well, I mean, this is a $4 or $5 billion company. Okay, so the loss is, in the hundreds of millions of dollars, but the scale of trillions versus, like a couple of 100 million, yeah, a completely different game. And why is the selling in Nvidia what it is? Well, hey, I mean, look at this. This is the 1-year performance chart of Nvidia. Yeah, this goes back exactly 1 year. Yeah, I mean, this thing just was like an absolutely rocket surge. And I don't want to get into an argument with anybody as to whether or not AI is real or it's hype or it's. I think AI is an absolutely enormous technology, but I have made the point over the last several years that AI is not going to happen in like a month. It's not going to happen like, in 1 year. It is going to play itself out like any innovation technology. There are going to be moments when, yeah, the technology really, shows its power. So bidding up a stock instantly all at once. I mean, I've been through the dot-com tech moment where we had similar sort of behavior, similar expectations. So I have something to model this on. And Nvidia has incredible products. So this is no knock against it. It's really just what we as humans do in markets, which is that we get very excited and we price in years and years worth of future gains, future developments all at once. And then we, as the price goes higher and higher, we also feel a little stupid. Heck, I felt a little stupid not owning Nvidia because it was rising every day. And like, how can this be a bad thing? I need to be all in. So that kind of like set everything up for what is happening now, which is that we've taken the mega cap tech sector up so much based on a future that I'm certain will come, but it's not likely to come as fast as what that chart was pricing in. And at some point, what happened was that someone decided that they're like, hey, you know what? Yeah, whether they were a short-term, medium, or very long-term owner, they were like, hey, I'm out and I'm gone. And so like now they're gone. So that's essentially what has triggered this. And obviously there was some amount of leverage there, but a lot of people just simply own too much. And there are, as they go to sell, there's nobody that wants to pay the previous high price. And that's obviously having a big impact, not just on Nvidia, obviously, it's having a big impact on the overall like market, because what, this seven stocks, seven of the tech stocks make up something like 30% of the S&P 500, equivalent numbers for the NASDAQ and NASDAQ 100. So these are very, very top heavy indices that are going to be very much swung by what Nvidia, Apple, Microsoft, Amazon, and Meta do. So I just have to say that there are folks that are working on my house, and so there's like, if you hear a noise, that's the noise that you're hearing. But we're going to try and make it through. All right, let's go on to another thing that is going on that very few people are talking about, which is that as markets sort of like levitated higher, this strategy of put selling became very, very popular, and people began to use it as a income substitute. Now, I responded to this person who was a avid put seller, and he was talking about how you can generate $4,000 per week selling options at 0.8%. And I made the point that, well, this is the kind of thing that people sort of like gravitate to and talk about when you've seen very low volatility, especially in very large, well-known stocks, and you have this persistent long rise that makes you think that it seems unthinkable at 130 that like Nvidia can go from like 130 to 99 in the space of 3 days. It seems unthinkable. But having been in multiple markets, I mean, including, all the way from the early 1990s when, I saw put sellers get wiped out. And obviously 1999, obviously 2007, 2008, I made this point, which is that if you're put selling and you don't have a hedge, you can get wiped out because, people, what are people doing today? I mean, if you bought a put for at any stock, maybe it's Nvidia, maybe it's Microsoft, maybe it's Apple, maybe it's one of our stocks, maybe it's Coinbase, maybe it's MicroStrategy. Well, you're being asked to buy stock at the price from like last week, and you can't obviously sell it because, well, it would be a huge loss, or maybe you don't even have the money to actually like take it all in. So there are margin calls going on everywhere, and I just went on X, and I was just wanted to see like what is going on with the folks that have been put selling. And obviously you can see some of the memes that are going. And this is one of the things that I've always told people, which is about put selling, which is that it's sort of like picking up pennies in front of a steamroller. The steamroller is coming. It's just inevitable. Like if you've been in markets long enough, the steamroller always gets there. You are not winning this one. It's just how long do you get to pick up the pennies before like, the wave comes and topples you over. So this is one of the other reasons why we're seeing this. In other words, as markets levitated up, obviously people wanting to participate in the AI trade all in. I mean, and it kept extending, obviously from Nvidia, then it went to Microsoft, and then it went to Apple, and then anyone that could really make a claim, to be somewhat connected to AI got the benefit. And then there was a lot of this behavior, picking up pennies in front of a steamroller, which is a kind of leverage that goes on in the market. In other words, you're selling puts, you're taking in money, but what you're really doing is selling insurance. You're selling insurance against a near certain hurricane that is coming. So this is what has happened as this this correction is going on. And I wrote in my Substack, which is that, I mean, let's like look at the facts as they stand, right? Okay. Which is that, what are we panicking about? Well, we're panicking about a potential recession. We're panicking about the fact that the Federal Reserve may be behind the curve. Listen, folks, the Federal Reserve is always behind the curve. Okay, I mean, they weren't behind the curve with COVID, but other than that, pretty much the Federal Reserve is almost always behind the curve. As I like to say, that is a feature, not a bug. Why? Because the Federal Reserve is not just a financial organization, it is also a political organization and a social organization. They cannot be too far ahead of the news. Why? Because they report to Congress. And the Congress, while we may think is filled with very smart people who are very well informed, that is not true. They might know the basic headlines. So anything that the Federal Reserve has to be somewhere, they can't be too far forward. It's better for them politically, certainly, for them to be behind, because at least they say, well, look at the news, like, whatever it is, yeah, that's happening, and we are now taking steps to correct it. So they're always behind the curve. That's always the case. The key question really here for me is this, which is that clearly we've had this enormous bull market for very large stocks. I mean, you can see that by the concentration levels in the S&P 500. The top 50 stocks represent well in excess of, like, I think it's like 50-60% of the S&P 500. The top 100 is like 70 or 80%. So the vast majority of stocks have such minuscule value. The key question really here is this. Do you believe that because we're going to see an economic slowdown, we may see a recession, but I believe it will be mild. So let's say an economic slowdown or mild recession, do we need to see a wholesale correction of all stocks? Because I can tell you, I'm just going to put up some of our stocks. I mean, I'll get ratioed by some of you people, but like, hey, yeah, I mean, many of our stocks have not done anything. They look like this. They are pre-crashed. In other words, these are all stocks that have not participated in this 3-year plus bull market that has just favored increasingly larger and larger stocks. Obviously, the big tech stocks, but then there's Berkshire Hathaway and JP Morgan and United Healthcare and all these big stocks. That's where all the money has gone. I take the view that because of the amount of money that Washington is spending, just, they keep spending an extraordinary amount of money, between the amount of stimulus that was put into markets by the Fed from 2020 on, and also that we have way more people participating in the market on the retail level, I believe that we are going to see a transition rather than a reset. A reset is kind of something like 2008. The prices of everything get reset, and now a new bull market starts from sort of like equal ground. In other words, small, mid, growth, value, they're all been hit, and you get a bull market come from there. In a transition, you kind of have like a washing over, right? In other words, you'll go from here, one set of stocks goes through here, and then another set of stocks will go through, we'll start to sort of like offset them and start to go higher. And that's what I believe is going to unfold in the second half of this year, because we are going to see lower interest rates. An economic slowdown is almost guaranteed to bring down lower interest rates, which is going to bring lower inflation. And that is the best environment for innovation and growth. Why? Well, because growth stocks do not depend as much on economic activity for their growth. They take market share from incumbents. There's something about their technology that gives a certain level of efficiency to it. And these stocks are now cheap. If you go and read what they have been saying, they actually continue to see brightening prospects driven by unique, unusual things like reshoring. So panicking today and selling everything, in my judgment, is wrong. I have laid out for several months now that the large cap sector has been overbid, it's overvalued, it's overowned, and everything about our stocks is the opposite. We have sat through, while those stocks were in a bull market, we've been in a bear market. So there is a chart that I've put up as well using what I call long duration and short duration. What's long duration? Well, long duration is something like the 30-year bond, right? I mean, the 30-year bond is long duration. And here's the chart. I've put this up before, and you can sort of see, make this a bit smaller. Okay, I think. There we go. So you can see that the red line that you're seeing there, that's short-term interest rates. That's starting to fade down. That's a great indicator that The folks that buy and sell treasury bills, they think that there's weaker economic growth coming. All the other lines there, it doesn't matter. These are all pro-cyclical or sectors that benefit from overall economic growth. And then at the bottom here, we have like the green is the 20-year ETF, and then we have ARKK, which is it's kind of like the standard for innovation ETF. And so you've got short duration investments that benefit from sort of like current activity that have gone up, precipitously for the last 3 years. And then we have long duration, which has gone down. As interest rates go lower, as inflation goes lower, the value of future cash flows start to increase in value. There are many people who will come in and look to make this trade. And what I believe we're going to see is like a reversal. You will see all of those things, which are what? Well, it's the big cap stocks represented in all the big indices. It's all of the sectors that are cyclical. What are cyclical sectors? Housing is cyclical. Semiconductors are cyclical. The commodities are cyclical. And what's on the other side? Well, ARKK represents, to some extent, smaller cap stocks, mid cap stocks, innovation stocks, growth stocks. We're going to see this handover happen. Now, there's going to be moments like this of volatility, but if I'm right, there's no crash. There's no like big smash that's coming. Instead, it's quiet and it's small, and there'll be moments like this, but it's going to be okay. It's going to be okay. And on the other side is a big bull market that is coming for our stocks that runs for many years, because until something else starts to take over from the economy for the lack of housing activity, the lack of any other sort of like business activity, we're not going to see like a strong economic environment where you have huge growth, which large companies depend on. They benefit from huge economic growth. They benefit from huge inflation. Our companies benefit from innovation, low growth, and where growth is scarce. Now, those investments trade at a premium. I can't take questions because I can take actually questions if you put it in the comments. Just gonna feature the comments and say thanks all for attending this live stream, this multi-venue live stream. But I will be on YouTube tomorrow, and there I can take direct questions from those folks that attend. We have a lot of usuals here. One thing I will say, if you're going to buy the dip, always just understand that selling begets more selling, buying begets more buying. So don't buy all at once. Remember, buy low, buy slow. Anytime you're in a hurry, those gains generally tend to get reversed. So the next run is going to go on for a while. Just like the previous bull market in innovation and growth lasted like 6 years, and we'll have something similar. They're washing right outside my window, so that's the noise. We have some questions here on GNRC and WBX. I am, let's see, GNRC, I think is Generac. I put that's a 5-year chart of Generac, right? And this is obviously a company that has not benefited from the bull market, which was mostly in very large cap stocks. So I have not been tracking Generac. We own a number of other players in similar space, the new energy space. But if I were to say this would be something that participates in the next bull market, if I'm right, but I don't know that. I do not know this company at all, Wallbox, so I can't say anything at all about it, unfortunately. And Liz is here. Hey, Liz, thanks for attending. A very strong supporter. Very grateful for your support as always. Elijah says, given the current nature of the market within the next 3 months, which sector or stocks are you most bullish on? Well, I mean, this is a complicated question because what's gone up over the last 3 months is just the very large companies. So everything else that didn't go up has a good chance of going up. But in what exact order, you don't know until the bull market begins. It's usually the place where there's very little liquidity right now. The growth prospects are very good. I've laid out scenarios to my subscribers at ATG Digital, and we're prepped for a big bull market in biotechnology in particular. Why? Because I mean, over these like last 2 3 years, the number of platforms and technologies that have not just gotten mature, like they're starting to earn money. Like I mean, some of the blood diagnostic companies. I mean, these were set to be like completely useless tech, profitless tech. They've gotten their products approved, so we're positioned for one place that, from my experience, and I've been on managing money for 30 plus years, is that low interest rates. I mean, every time that I've ever seen, biotech has always participated, and it's been one of the early sectors to participate. So that would be one place I'd be look at. Stocks, there's so many. I think like maybe as much as 40% of our gold and diamond tier might be biotech. I can't put out all the stocks that are there, but in our silver tier, which is our introductory tier, which goes for $9.99 a month, we own Gilead, we own Sarepta, we own a number of stocks, and I tell you to look there. Leonor says, thanks for the insight. Why aren't you talking about the BOJ and the carry trade? Yeah, I mean, we can get involved in a very technical basis, but it's a very macro-driven trade that has some kind of impact. But that's on a very, very high level. It's not so clear to me like how much that funded the extraordinary valuations in big tech. It's not so clear to me that's the most critical factor. I know there's like one group, one set of folks on social media that claim that this is the thing that matters. Not so clear to me that it's the thing. I think in general, if you go and see, I mean, you've got stocks like Apple that have shown very little business growth, completely driven off of buybacks, go from what 16 times earnings in 2016 to 35 times, where nothing's there. Is that driven by the yen carry trade? It's not so clear to me that that's the critical factor here. I mean, I think it is one of many different things. It definitely provided some cheap funding. The put selling was part of it. The AI fever was part of it. Retail participation in markets in general is part of this. It's all sort of like a mix. I don't think you can really point to one single thing. Marilyn asks, what about crypto? Well, I mean, one of the things that happens in panics is that people sell and ask questions second. Which is that, I mean, selling Bitcoin because Nvidia stock is down 50% from the top, or because tech stocks are down 30%, or because we're going into a weakening economic environment where the Fed is going to loosen up liquidity. In other words, more money. That is, I mean, hopefully I'm not offending anybody. That's just dumb. I mean, the entire sort of like rationale for Bitcoin is that more liquidity absolutely is 100% benefit to Bitcoin and to crypto. So that's just pure emotional panic. That makes no sense at all. I mean, if you are thinking that the Federal Reserve is whatever it is, maybe it's 1 month, maybe it's 3 months, maybe it's 6 months, but slower economic growth, something like a slowdown or recessionary conditions, lower inflation, and the Fed is going to pump more liquidity into the economy and into the markets, that is 1,000% bullish for Bitcoin and is 1,000% bullish for crypto. And that's my opinion. So I think people who are selling, those folks, this is some of it I think is just like leverage. I mean, there's an extraordinary amount of leverage on the way up in crypto. You can get 100x derivatives, you get 50x derivatives. So people load up anytime there's a big pump. And then, with today, I think we're kind of like really washed out. I thought we were washed out at 53,500, but at 48, my best guess is that all the folks that were betting on pumps are out, and they're probably now going the other way. They're like, it's going to go to 35 or it's going to go to 12,000. But facing the potential that we are going to see lower interest rates, lower inflation, lower growth, I'm going to say that's a very, very bullish scenario for Bitcoin and crypto and for innovation and growth. Liasim says ARK has massively underperformed the market in both bull and bear markets. Poor stock picking. That's not true. I mean, they peaked in March of 2021, along with a lot of the stocks that go into the innovation sector. So it depends on when you want to measure. I mean, people literally until 3 years ago were showing you incredible charts of how they'd outperform. So at the bottom and somewhere near the bottom, this is how it all looks. It looks terrible. You can fault their stock picking. But I mean, it wasn't so long ago that, everybody was lauding Kathy Wood as the greatest genius ever. The thing is that there are market cycles, and we don't need zero interest rates for innovation and growth to boom. Just like large cap stocks, were at low prices when we had very little growth, very little inflation. Why? Because they benefit from inflation. They benefit from huge cyclical growth, and so on a relative scale, based on safety, based on valuation, from sort of like 2021 on till now, they could get growth. They benefited from raising prices, but that game is pretty much done. You cannot raise prices in a slowing or recessionary style economy. And if interest rates are going lower, it means that cyclical economic activity is going to be in decline, which means that these big companies, just by function of how big they are tied to national and global economic cycles, which means that their sales have peaked, and you will see their sales and earnings estimates decline. So the key question you're really here is that do our stocks have enough innovation? Do our stocks have what it takes really to still benefit? If you go and read company by company, they are telling you like, hey, we are still growing. I mean, you would not know this, but there is a factory boom going on in the United States as we bring production back from China and from other places. So that's not, why isn't that a big deal? Well, these companies that are benefiting are so small. They're in that 400 companies in the S&P 500 that have gotten no money, that are trading for almost nothing. And those are the companies that I think are going to get investment dollars. And you can see those move up with small amounts of liquidity, with the amount of liquidity that the Fed's going to throw in. I mean, I was going to say before that the Fed will probably cut by 1%, but my best guess is that by the end of the next rate cycle, the Fed will have cut by probably, I'd say, between 2 and 3%. We'll maybe get to 2.5%, 3% interest rates for Fed funds. And that's plenty of liquidity for our stocks to go up. What do I think about Walmart and Amazon? Well, those two have definitely participated in the big cap bull market. I would not be a buyer of either one of those. Here, you will need they will need to go. Sellers will. There's people have loaded up on these, and if I'm right, no guarantees. There will be sellers, on a stair-step fashion on the way down as market pursues growthier companies than what's there. Mark says all planned. Cheryl says I did buy Nvidia. This would be much of a loss. Well, I mean, I've made this point unpopularly for the better part of almost like 8 months, which is that AI trade resembles the .com trade. And when people have asked me about semiconductors, and this is from someone that has bet on semiconductors, in my 30 years of experience, you buy semiconductor stocks when they look like they're going bankrupt, and you sell them when they look like they're at peak health. And if you go and look at these companies, whether it be their stock charts or their financials, they're much closer to peak health. These are cyclical companies, and from experience, after the peak, they tend to lose about 80% of their value. You may not like hearing that, but that is my experience. That was true in 1999, 2000. We didn't have a semiconductor cycle really until 2016. And if the previous patterns are the same, it'll show something different. In other words, these things look great at the top when you want to sell, and they look horrific, brutal. Like, we put ST Microelectronics and AMD. I mean, AMD almost went bankrupt at the bottom, but that was the bottom. That was the bottom. They don't look bankrupt at the top. So that would be my viewpoint. Twist Biosciences, I have looked at that. They just reported their numbers look good. I'm not 100% sure about the quality of that company, so I've always been reluctant to recommend that, and I don't know what TMDX is. I'm just looking that up. What is TMDX? TMDX is Transmedic Group. Okay. Transmedic Group. I have to say, I do not know this stock, so I don't want to comment on something that I don't know. So I have to pass on that. But maybe I'll do a multi-venue live stream where folks can throw me stock names and I can come to it. Yeah, I mean it's a biotech, but I mean I have to know more than that. I mean, it's like, well, what kind of biotech are they in? In what lines are their drugs, and at what stage? How much cash do they have? What are the clinical trials shown so far? Is this a good bet or not? So I would need to know a lot more things before I want to present an opinion, my view. Senators, what a wild ride it has been. It absolutely has been. Pretty much really since COVID began, it has been a series of things that were, I've been through a lot. Like I just wrote my Substack today, and I graduated college in 91. That was a recession, which lasted till 1993. And then I remember the Fed cutting, I think it was like in 94, feels like a very similar time. And then we had like a couple of good years. And then we had there was a panic driven by Mexico. There was a panic from like Asian currencies. Then there was the long-term capital panic in 1998. Obviously 1999, 2000, the dot-com bust and technology and general stock bubble. Then we got 2000. Then we have 2 or 3 years of the 9/11 attacks. Since 2002 when the markets bottom out. Then we had relatively smooth markets as the real estate bubble picked up and real estate finance bubble picked up. 2007, 2008. Then we had all the mini crises post the great financial crisis of 2008. In 2016, we actually had a growth stock crash that most people don't think about. Then we had relatively smooth-ish markets all the way really until 2019, 2020. Then there was the COVID crash, the COVID recovery in markets, the growth stock crash. I mean, as the saying goes, there's always something. So, I mean, if you're in markets long enough, you'll just count these, and you could just maybe just mark, on your finger. If I just, those are all the events. But if I actually count the number of panics I've been through, it's got to be in the hundreds, maybe even close to 1,000. I mean, panic on a stock, panic on the market, panic on a sector. There's always someone that's over levered, owns too much, had too their expectations were too high. That's what drives the panic. We got some more here. Do you think earnings will play a part in creating movement in the stock market for our stocks, or do you think the interest rate is more important? Well, there's the earnings will be there, but if people also have a macro layer to this, where they're if you remember in 2021, one of the things that was said was that, well, if inflation is rising, then future cash flows are worth less, right? So if inflation keeps going up, then, let's say if you're a company that's in the innovation sector, like Exact Sciences, and it's well, our peak earnings are going to be 25 years from now. So there are people who say, well, if you discount those earnings under rising inflation, they're worth less and less. Equally true that if inflation is going down, well, those peak earnings are worth more and more. So we've got a scenario where our companies over the last 3 years, they have right-sized themselves. It's no longer growth at any price. Now it's growth for earnings. So they're going to have actual earnings. And their platforms, technologies, products, and services are more mature, more targeted. So they will have real growth with earnings, with, again, the macro layer benefiting them. So it will be both. It will be both. Hey, Paul, this feels like a punch in the gut. What do you take to that feeling away when you see a big dip like this? Um, I think truthfully, I don't know how old you are, but I think if you've been through markets long enough, I think the key factor is not having bet so big for big gains like immediately. So then any movement sort of like if you're like sort of like have set yourself up to expect it, it never feels like quite as a gut punch. And the number one way you do that is position sizing. We're all very tempted, even like I still do this, but not like to excess. Like maybe like okay, I pitch Teledoc and I go buy some options, because I'm like, hey, I want to participate at the bottom, but I still keep the size relatively modest relative to anything that I own. But the temptation is always there, really, at the top. And as bottoms near, there's always one more leg down than you think. This has been consistently true. Like I think this is the bottom, and there's one more leg down, and that one still, like even if you're positioned a little bit, it feels like a gut punch. But if you don't bet too much, then the gut punch is a lot less, like that's there. But of course, the flip side is that every once in a while, of course, if you bet all in or whatever, you take a large position, it works out, it can make you a lot of money. So, I mean, everyone has to find their psychological sort of like, comfort zone and go with it. But it's certainly over time, having gone through so many of these. I mean, I didn't wake up this morning in a panic. I'll tell you that. I mean, I checked, to see like, okay, I could see the liquidation going on in the crypto markets. And I was like, okay, I see the pattern of how this is trading. I understand what's going on. I see what's going on with MicroStrategy. I see what's going on with Nvidia. I see what's going on with Apple. I see what Warren Buffett sold half of his share, half of all of his shares of Apple. And, having been through this, I have a viewpoint. Doesn't mean all the viewpoint is right, but I have a viewpoint based on obviously the price action, based on the evidence, the research, and that preparation also helps like you a little bit. In other words, you're never going to get them all right. You should never expect to. And this is why you also own a portfolio. But it's a great question. I mean, whether to be a trader, a speculator, or investor, the biggest really positive that you have to have is temperament. I mean, Warren Buffett talks about that, which is that you got to keep your cool when things are, crazy. When there's bedlam everywhere, you got to keep your cool. You don't have to necessarily do anything. Not every panic requires you to go all in. You don't have to do anything. And I made this point in my Substack. You don't need to buy, right? You just need to be like, okay, is there a logical, evidentiary, fact-based case for what I do own? If it's so, why should this price swing make any difference to me? And we don't buy purely, we're not pure price traders. I mean, those folks are purely based on charts and are technical, right? We're using, I mean, I definitely look at it, but I look at it more to understand where the psychology of the market is. We are primarily basing our judgments on like, hey, we're in a period of extraordinary, incredible technological uh, uh, innovations, and some of these are going to be extraordinary. I mean, they're going to be huge. I mean, obviously AI is one of them, but there are others. There are many others. And that is very, very, very unique. The only other time that I can think of is the Gilded Age, which is like the mid 1800s on, where we have obviously railways, and then there's the automobiles, and then there's telegraph and telephone and they all come in a series, and we're in a similar time. So that's my basic assumption on like why stay invested now, because there are an extraordinary number of like incredible technological innovations that are just being let loose. And yeah, there's going to be days like this. There's obviously going to be years like what we have just experienced, but we only need to get like 2 or 3 of these right. And if you hit those right, I mean, yeah, that could be it. Maybe it's Bitcoin. Maybe it's one of the, the um, biotech companies, or maybe it's one of the new energy companies. These things hit. Yeah, I mean, just owning a small bit can mean a huge difference to your life in the future. Raul says, thank you for your insights. Been around, and you're right. The gut punch is not as bad. Still, it hurts. You're right. I'm non-panic. Waiting. So yeah, then take it. But remember, you don't have to do anything. right? I mean, many people feel like when prices are low, hey, I got to buy. You don't have to do anything. The first thing, actually, I would always tell people is like, the first thing to do is do nothing, right? Then make a plan and just try and write it out. Like go at night when it's calm, be like, okay, are you really up for it? Because like oftentimes there may be another leg down, and that will feel like it feels more and more of a gut punch if you did something where you thought, I'm going to be right. I'm going to get the bottom, and then you're wrong. Then the psychological sort of like turmoil you go through, that's what sort of like makes you make, be like, okay, I got to sell. I want out. I just want to end the pain. Ryan says, first off, thank you for the great insights through the years. What do you think maybe the top 3 or 4 stocks to buy the dip? I think it's more like you really have to think through like, hey, is there going to be a transition? If you think like, if you agree with me, it's going to be a transition, then it's really a group of sectors. It's like what sectors have investors sort of been eyeing, and we have clearly seen buying in somewhat of fintech, crypto related. They're all selling off, but people are interested, right? I mean, how do you know? Well, they've been willing to bid it higher. The other place where we've seen bottoms is new energy stocks. So there's been buying where people are excited about the technological prospects, excited about the financial prospects that are there. So, I mean, biotech, fintech, new energy, these are places where we've seen trades. In fact, this morning, we did some buying in our trading tier, which is the platinum tier. We bought into the biotech. We bought calls on the 3x biotech leveraged ETF, and we also bought calls on the small cap 3x leverage ETF. Will this immediately shoot up tomorrow? No, but look, these prices are if you have I think like a 30-day time frame, 45, they'll probably go a little bit lower. They'll also go higher. It's going to be impossible to be like this perfect absolute. This is the absolute bottom. You're never going to hit it. You need to have the viewpoint that low prices are a range, just like high prices are a range. You have to be willing to sell at the high price range and buy in the low price range. And then you give yourself enough time to be right. This is how, I have gone through the world. And then you got to kind of like sit around and do nothing. So here's one more. Thank you so much for this. Only regret is that I didn't sell my Nvidia and MicroStrategy when they were up. Well, I mean, you have to have a viewpoint on the world. I have a viewpoint on Nvidia, so it's very easy for me. I was like, hey, in my opinion, the AI hype and mania is very similar to .com and tech. So that one, I never got involved in since I mean, we sold the vast majority of our. I mean, we sold SG Microelectronics very well. We sold AMD pretty well. We sold most of the rest of the semiconductors okay. In other words, there was more upside, but like, hey, in 2022 wasn't so clear to me that there would be a high, like massive trade that would take them all up. But we're never getting involved in the semiconductor space for a long time because, like I said, my experience that you buy semiconductor stocks when they look like they're going bankrupt, and you sell them when they look like they are in like rude health, and they all look like they're in rude health. They have massive amounts of money at the bottom. They all look terrible. Their gross margins are terrible. They don't have cash. They're all desperate. That's when you buy them. So that's easy. MicroStrategy, we're still bullish, and we're going to own that for a very, very long time. So I have no regrets of not selling MicroStrategy. In fact, my kids work. They've been working all summer. They have some money. Like, okay, what, at $1,100? I'm like, okay, go buy some. So I'm still bullish on that. All right, I think no more comments or questions. Thanks everyone for attending this live stream. I will be on YouTube at, I think usually I do it at 12:30. I'll try to be on time, 12:30. And then also on Facebook. On Friday, I'm going to do a live stream. So bring your questions. I mean, if you throw out stocks, I know some of them, but I don't know all of them. I will generally can give you some viewpoints. So bring whatever questions you have, and I will see you all soon. Thank you, everyone. Also, just rapid plug for subscriptions, atgdigital.media. If you're looking for ideas on what to buy, And I'm not doing portfolio updates this week, but I'll be back next week. So check it out. All right. Thanks, everyone. This is Paul saying bye.